Good morning, and my apologies for being a little late. My flight just landed. It is my pleasure to have been welcomed today here at the Economic Times Insurance Summit today in Mumbai. I thank the organizers for inviting me to share a few thoughts and exchange views on the subject, creating benchmarks to value insurance companies. Now, it's a very difficult subject. I try to figure out what benchmarks are there after I accepted, what benchmarks should be there. And therefore, what I'll do is I'll spend some time talking about what's happening. I was in Amsterdam last week attending, the Global Insurance Meet organized by the IAIS. And I can give you a flavor of what's happening in those markets, particularly the developed markets, and some of the subjects which came up for discussion. And then I'll get into this main topic, and of course I'll share with you some thoughts on what the insurance industry has been, what are the challenges for the insurance industry and what are the opportunities in Indian markets, and how the global players look at India as a very potential market for growth. As the earlier speaker mentioned, that the penetration levels in India are low, and therefore they look at it as an opportunity for growth and development. And some of the developed markets, the growth has almost reached a peak, and in fact there are withdrawals. In fact it's coming down, particularly on the life insurance side. Though there is some growth on the P&C market, even on the reinsurance market they are facing challenges from the capital markets. So that's the broad trend which is happening. So the first topic was, on the challenges faced by the insurers globally. And I can tell you that most of the challenges they face are the challenges which we are also facing here today. I happened to listen to one of the very famous regulators from the UK, Howard Davis, and he was of the view, he gave us a flavor of what's happening in the US and UK markets. And he said that, markets are at an interesting stage now because the interest rates seem to be, it will be low for quite some time according to most experts. But we can expect other asset classes to be volatile. That's one view. And then, what can be challenging is particularly the insurance market in the West particularly, the challenges are for giving returns on guaranteed products. They are facing a lot of difficulty in payments of guaranteed products. But in UK, it seems the life insurance industry has actually, they received a premium of 162 billion, but there were outflows of 194 billion. So the net outflow in the UK markets, in the life insurance side. And the annuity side, due to political pressure, earlier you were not allowed to withdraw as till once you retire, it has to vest with the annuity player. But now they have allowed people to withdraw the money also. So there is a kind of stagnation even in the annuities market in the UK. But the P&C market seems to be doing fairly well. And looking at the US, which is the largest market, the premiums are flat there in the US also, life insurance premium. But the important thing is market capitalization of big insurance companies have fallen from 40 billion to about 25 billion. So there's a huge fall in the market cap of huge companies. So they are looking at emerging markets as will provide 85% of the growth. That is the view which is being taken by very respected regulators and market players in those markets. So the life insurance needs to, I think, adopt and switch from what is called defined benefit to defined contribution. They want to pass on the risk to the investor from the institutions. But they say that risk sharing is a very good opportunity for insurance. And the smoothing of risks and risk proofing is something which they are looking at as opportunities in the growth of the life insurance products. And they believe that variable annuity is the way forward. And variable annuity, of course, is a very challenging product to sell. Because the investor doesn't know how much money he'll get at a later date because it'll keep varying with the change in interest rates. But that is the way to go forward. And The regulators and supervisors have another challenge now. There's been always an arcane debate between the regulatory actuaries and the government actuaries on the prudential structure. And in the UK, the insurance regulation has gone back to the Bank of England, and it is under the PRC now, Prudential Regulator, and therefore they are of the view that the insurance regulator also should be looking at macroeconomic and financial stability aspects. Earlier they were looking at only at policyholder protection as one of the main themes of the insurance regulator, but they believe that insurance regulators need to move ahead of the curve and look at even macroeconomic impacts and financial stability. And lastly, the governance issue came in, saying that the board of directors of insurance companies need to engage with the regulated entities in a larger measure so that the expectations of both can be managed. And he came with a word which actually was a very interesting word. He said that regulators should not be recklessly prudent. Therefore, they should not have too much prudence and then kill the industry. And that was one of the words which struck me as a very interesting observation, because after the financial crisis, most regulators have tended to take very firm regulatory measures to, and of course this gentleman was a regulator himself. Now he is a market player. He is a risk manager for JP Morgan, and he says that they should avoid being recklessly prudent. And that was a very interesting word which came up in that discussion. And the future challenges, in my view, for the insurance industry, particularly life and general insurance, would be moving to a risk-based solvency regime, which will fundamentally change the way insurance sector will operate in future. This is my thinking as I go along. And the other interesting thing which I think will emerge is the new accounting standards, the IFRS, which will come up, and which will also change the way the balance sheets of insurance company would get reported. But we see that health insurance and life insurance business and even catastrophic insurance would be the way, there will be a lot of potential opportunities. And the challenges of insurance industry for both the insurer and the regulator would be how the risks are being managed by the industry and how the regulator is able to even perceive and understand those risks. And from the regulatory point of view, the challenges would be whether it should be principle-based regulation or rule-based regulation. It's a debate going on even internationally. We have rule-based regulation, but there is a talk about going principle-based at the FSLRC, whether it should be top-down or bottoms-up, whether there should be proportionality in the kind of regulation, depending on the complexity and the size of the player, whether we should have higher loss absorbency limits for larger players, and for very small players there should be a little less of regulatory rigor so that there is a level playing field. And of course the insurance business model itself is coming into question now, whether the model needs to change now in terms of their ability to reach out to customers and deliver it. And of course the integration of international regulation with the national regulation. There is a lot of pressure now on countries like India to adopt international global standards, though we have not reached there in terms of our market development. There is a lot of pressure because we are part of G20 now, we are part of so many other international bodies which tend to adopt global standards. India is being assessed for financial sector assessment by the World Bank and the IMF. And India is considered to be a very good country in terms of its adoption of the insurance core principles of the IAIS. But then, it will always put pressure on the insurance companies to adopt those standards, and, it may have a potential cost. So how do you balance the potential cost of adopting international standards with the stage at market development we are? And finally, the fair treatment of consumers, I think would be a great challenge, because the consumers will demand greater attention as we go along. So there are challenges, and of course the technology itself, how do you reach out to these masses? Of course, this was the broad theme of the conference in terms of the challenges that the insurance industry in general will face. Then of course we had a very interesting debate on two subjects which I will mention in passing. There was something on inclusion, which of course we are doing very well as a country. India is considered a market leader in the insurance. We actually chair the IIS committee. Chair is an Indian. But two things which are there which is not there, which may come here, is the low interest rate regime which is prevailing in the markets there, and that's causing a lot of challenge to the insurance companies in delivering potential returns to the policy holders. Continuous low interest regime for nearly 10-15 years now, and they are seeing that another 5-10 years also the interest rates will remain low. So how does insurance meet challenges there? Is in delivering very good returns to the policy holders is something which they are grappling with. The other is the risks which insurance companies are taking now, because banks, being over-regulated or highly regulated, have stopped lending in some areas, and insurance companies are stepping in there in those markets. It's not happening here as such, but in those markets the investment regulations are a little more liberal, so they are entering into risky areas like real estate and financing of infrastructure projects. Of course, they are potentially better in terms of asset liability mismatches. They are better equipped to handle that, but then they are also taking high risk and to get high returns, and their investments in the corporate bond markets in some of the risky corporate bonds is a cause of concern in terms of though they are going for high return, whether it can have an impact on the balance sheet of insurers in those markets. We are not seeing those things happen, but we should be prepared, because it's a matter of time. What happened in Japan is now happening in Europe, and they are saying that Europe may face the Japanese experience now of 10 years of no growth and low recession, and therefore India is also developing, and we can't be having very high rates all along, interest rates. As long as interest rates are high, people are happy, but once the inflation drops and the interest rates drop, there will be challenges even for the insurance industry, though not to that extent that we face in those markets, but it will also come here also. So, and the other thing which came in for a debate was, I thought I should tell the audience, was on, they want to have a uniform capital standard now, which will be a language like the accounting language of IFRS. They want a universal BCR, they call it, the basic capital requirement. And then they want to adopt what is called the ICR also. This is for very large players. That is, it will be an international defined capital standard which will be uniform across all countries. Now it's a big challenge to, they are not, the countries are not able to agree even on accounting standards. How will they agree to a common capital standard? But that is the goal of IIS. They say by 2018 they want to have, at least for the large players, they call it GC5s or the internationally active insurance groups. Such groups will be subject to this kind of capital rigor if they have to operate in the international markets and meet the standards of the IAIS. Now these are very interesting times for the development of basic capital standards and basic capital requirements. With this, I thought I will now come to the subject today. I tried to understand what is benchmarking and insurance value, and I went back in history. In 2008, I think Economic Times had a similar program, and I believe IRDA did come up with something at that time, and they put a committee, but I didn't get the report of that committee, and Mr. C.S. Rao and Mr. Harinaran had spoken, it seems, at that time, and there's a need to develop the evaluation model. But then, the insurance bill has not gone through since that time. We are hoping it will go through. This valuation of companies would come when investors would try to get into when companies go to the market and try to list their shares in the market, and it's going to be very important that companies would meet those standards of disclosures and transparency and accountability that is required by the capital market regulator. So after that, what we have done is in the IRDA, and I have tried to understand how insurance companies are valued globally, and I did come across an interesting paper, how to value an insurance company. Most investors avoid valuing financial firms due to their complex nature, and however, a number of straightforward valuation techniques are available which can probably allow you to value a company. But Insurance company valuation is a little more difficult because of the nature of the subject, because the concept of insurance is that the firm pools the premium that pays customer to offset the risk of loss. This risk of loss can apply to many different areas, which explains why health, life, property, casualty and specialty line, we don't have those businesses here, but they may come, but they exist. And the difficult part of being an insurer is properly estimating what future insurance claims will be and setting premiums at the level that will cover these claims, as well as leave an ample profit for the shareholder. Now this is a challenge of insurance. It doesn't exist in banking. Banking is pretty straightforward, but in insurance, and above that, beyond that, what happens is the core operations, insurance run and manage investment portfolios also, and they are fairly substantial. In the Indian market, I can tell you today we are, insurance companies are having an assets of about 22 lakh crores, which by the standards of the Indian economy is considered pretty high. Though the penetration is low by global standards and the density is low, if you look at the AUM itself, that's pretty large, because Indians tend to save and invest through insurance policies. And so 22 lakh on a GDP of less than 2 trillion is about 12%, 13% or 14% of GDP, which is considered to be like developed markets. In fact, when India's assessment was done by the World Bank and IMF, they said the footprint of insurance in India is very large, and in terms of the AUM. So you have different measures of penetration is one, density is one, but if you look at AUM per se, it's a very large industry, and it's a big elephant in the room because they are large investors in the domestic equity and the debt markets. So on a 22 lakh crore, roughly about 50% is in government securities, about 26% is in corporate debt, and about 19 to 20% is in equity. So it's very huge in terms of the size. Both the corporate bond market and the equity market, insurance companies act as a big backstop in terms, whenever there are financial crises, you find that insurance companies have an advantage because they have to pay claims only when it is due, and therefore they are liquidity plus all the time. They have cash in their hand all the time, and they also get interest and income on their investments, and therefore there is a lot of cash flow coming into insurance companies. India doesn't have reinsurers too many, only one reinsurer is there. Globally, reinsurance companies also considered to be very cash rich, and that is why people like the Warren Buffett and all own large insurance companies and use that liquidity plus to invest. Now that's an advantage to have a large insurance industry because they act as stabilizers in the financial markets. So when the foreign investors are there to sell, you will have insurance companies on the buy side, and generally because of the liquidity factor, they are able to buy at good prices and therefore smoothen out their returns over a long time and pay investors very handsome returns in the long run. Now I'm going just sidetracked a little. The funds of these portfolios come from reinvesting profits, such as earned premium, where the premium is kept because no claim has occurred during the policy's duration, and from premiums before they are paid out. The second category is known as float. Now this float is what Warren Buffett says is in his annual statement. When he made it in 2000, he made a very interesting statement in which he says that to begin with, float is money, but we hold but we don't own. It is an insurance operation. Float arises because premiums are received before losses are paid, and the interval that sometimes extends over many years. During that time, the insurer invests the money. This pleasant activity typically carries with it a downside. The premiums that an insurer takes in usually do not cover the losses and expenses it eventually must pay. That leaves it running with an underwriting loss, which is the cost of float. And the insurance business has value if the cost of float over time is less than the cost of the company would otherwise incur and obtain funds. So ability to manage float profitably is a core of many insurance activity. Particularly, he was talking about his business of reinsurance, where he runs a large portfolio of large amount of money is available with him. But business is lemon if the cost of float is higher than market rates for the money. Therefore, even though you have float, you should be able to invest wisely to get good returns. Otherwise, your business is lemon. You will have a problem when the actual policy is to be repaid. So this is what makes valuation of insurance companies very difficult. So an investor has to trust the firm's actuary are making very sound and reasonable assumptions that balance the premium they take in with future claims they will have to pay out as insurance payment. So a lot depends on the skill with which the actuary is doing the underwriting and pricing of insurance. Major errors can ruin a firm, and the risk can run many years out or decades in the case of life insurance. So it is a risky business if the underwriting is not done very properly. Therefore, generally what we do in evaluation, there are a couple of metrics. There is price to book and there is return on equity. Price to book is a primary variation that relates to the insurance company's stock price to its book value, either on the total firm or on the per share amount. Book value, which is simply shareholders' equity, is proxy for a firm's value and should exist before it's completely liquidated. So price to tangible book value strips out goodwill and other intangible assets. So the quick rule of the thumb for insurance firm is that they are worth buying at price to book levels below 1 and are pricey on the side of 2 or higher. Now that's his thumb rule. I'm telling you, as a regulator, I don't have a view on pricing. I'm only giving you some flavor on how insurance companies are valued internationally. We will have these challenges for investors as we go along when we see listing of insurance companies. But generally, he says a book of 1 is a good price. And then, then they also have what is called the return on equity. Is the measure of income levels of an insurance firm generating a percentage of shareholders. So return on equity of 10 is considered very good. Firm which is generating a return on equity of 10% is supposed to be a good. So I've given you 2 valuation metrics. One is the price to equity and book value. And third is they also look at what is called the other comprehensive income, which is something special in insurance, which is not there in other financial firms. And they say that the people look at the OCI and look at the unrealized gains which are there in the OCI and then value the firm. Because there could be a lot of potentially a gold mine in the investment side of the firm which is not actually realized, but it is there in the balance sheet of the firm. So other measures are like combined ratio, which measures losses and expenses as a percentage of earned premium. So that is another measure for particularly the general insurance companies. Any ratio of 100 above means the firm is losing money on its underwriting, and therefore that would be one ratio which would be looked at by investors. So some investment banking look at discounted cash flow also as a method which can be used for valuing insurance firm. Of course, they have given examples. The bottom line is these are some important ratios or benchmarks, you can say. I won't call it a benchmark, they are more like ratios, because benchmark is more when you value something in relation to something else. But this could be potentially the ratios which an investor could look at in terms of their, it is very difficult for, like I have been a banker for many years and we had very simple banking operations were relatively simple. You could work out the profitability and look at the return on net worth very easily in the banks, and in the old days they said any return on assets of about 1% is a good return for a bank. There are banks which are very good, we are having 1.5, 1.6, and good banks may have return on assets of 2%. So below 1 they said no, it's an aspirational thing to reach 1. So, but in insurance it is difficult because of the what I mentioned in terms of the investment book and the role of actuaries and the potential losses that can come at a later date, and the fact that there could be a lot of wealth which is lying in the investment book of the insurance company which has been built up over a lot of time. These are some brief thoughts I thought I will share you. As far as the IRDA is concerned, in terms of what we have done is we have come out with the guidelines or the regulations for companies which wish to list, and we have gone by what is saying that at least the embedded value of the firm should be 2 times when they go for a IPO or issue of capital. Of course, I think the market is probably waiting for the bill to come out, and then the uncertainties of to be cleared, and probably we could see some potential listing as we go along, maybe in the next financial year. But we have said that any firm which wants to list should have an embedded value of at least 2, and we have gone beyond the SEBI disclosures. We have worked very closely with the Securities and Exchange Board in a group called the SCODA, in which we were also partners, and they were very keen that since insurance is a different type of business, the kind of disclosures that need to be made for investor protection needs the stamp of the insurance regulator, particularly since no public issue of insurance has been made so far. And so we have come out with those disclosures with the regulations for both life and non-life. We have also come out with the guidelines for mergers and acquisitions of insurance companies. So far, nothing has come. No mergers and acquisitions have come, but the regulations are in place, and the valuation matrix which is required for both the Indian market in terms of the we have not reached the stage of the Western market, but we have come out with some investor protection measures in terms of additional disclosures of the risk factors which the investor should know before they invest in an insurance company. So I must close this presentation now, and I think we are going beyond time, but I must thank the organizers, particularly the Economic Times, for inviting me and sharing my views. Let me also make a disclaimer. Most of the views are my views. It is not the views of my organization which I represent, but I have given you some thoughts and some ideas what's happening internationally. Some of what we have done is, of course, the views of what we have done as the regulators in the market, but I see exciting times for the insurance industry in terms of raising capital, in terms of listing, and there is a lot of interest in the Indian markets and the emerging markets by the foreign players, and so a lot of uncertainty is probably going to get cleared over a period of time, and I believe that this market will grow. We believe that Indian insurance can reach out. We have excellent players in the market, both public sector and private sector. There is good competition. Perhaps there is more competition required. We hope that there will be more innovative products for the insurance customers over a period of time. We have seen that competition has brought a sea change. From a single player, we have 24 life insurers. From 6 general insurers, we have about 27 general insurers. And though the premiums have grown, and the assets under management have grown nearly from 2 lakh crores, it is now 22 lakh crores in 10 years' time. So potentially, I think we have grown well. It is a fact that after 2010, the growth has been a little low because of the fact that the ULIPs, there was a regulation which came in for ULIPs. But now we are seeing that even in the ULIPs, money is coming in some players that they are able to market the products, which is giving better value to the customers. So once again, I thank the organizers for calling me for this morning session, and I wish the program all the best. Thank you very much.